right, good afternoon. This is a meeting of the BET Budget Committee. On our agenda today, I believe there'll be a motion to add under new business a discussion of the salary budget for employees in non-settled or unsettled labor contracts. Do I have a motion to add that?
So moved.
And I would second
All those in favor?
Aye.
Any opposed? No. So we will add that item to the agenda as well. In this month, we did not get any requests for budget items, so we're only into our discussion items. During the budget deliberations last month, we went through the numbers, but we did not have a discussion of the resolutions or the debt model, and I thought that we'd benefit from having that today. So if we want to go through our resolutions,
Why didn't bring my budget book?
we can share. Here we go.
Thank you.
I know that there were several new budgets item, but do you want to just go through page by page to see if there's any specific item a member wants to comment on?
The only thing I would, is anything that's new or added or modified.
Okay.
The ones that are existing from prior years are fine.
I do know, so if we start with, on page 2, number 10, which has to do with the Harbor Management Commission, I know that there's some discussion to delete this particular resolution. And I think the concern is that the appropriations could be used without action by the BET, if that's the concern. I don't know if any members here had the concern. But the way it's written, it would require BET to approve a budget and the use of the appropriations.
Last year, the Harbor Commission came to the BET and had their budget approved. And Leslie, I can't remember when it was, but I think it might be the June agenda. And at that point in time, Frank Mazza, if I remember, Roland, he had us, you basically extinguish any extra funds. And so...
They'll be coming next month.
Okay, so they'll be coming to our April meeting.
So, if I may, I didn't come prepared for that, but I had an opportunity at some point to look back at the authorizing statute that authorizes the establishment of these harbor commissions. It makes it a creature of the state rather than a creature of the town. And I thought I was seeing in the statute, and I'm sorry that I didn't prepare for it, but I thought I was seeing in the statute an authorization, independent authorization from our budgetary powers for them to collect fees and apply the fees in accordance with their approved plan. The issue before was that their plan had not yet been approved by the BET. So funds were being collected and were set aside in a separate fund. Roland will be able to tell me better, but I thought it was in the figure of perhaps $200,000 had been accumulated. And we were administering, we were asking them to go through a budgetary process and releasing the funds because those were not the Harbor Commission's funds. They were collected prior to the establishment of the accepted plan by the RTM. But now that there is an accepted plan by the RTM, I'm not sure that they need to be coming back to us. And you may wish to be dealing with that in some way if we wish to be exercising any kind of a supervisory power. And I'm sorry, I don't know the specifics of it, but I think maybe with the aid of the law department or the law committee, if you go back into the statute, I think that will afford some answers for this.
Okay, so we'll have to look at that before the vote. Mike.
This resolution currently has to remain in the book because otherwise they can't collect the fees. It's a resolution for the ordinance, and I think the assistant town attorney has opined on that today in writing. The issue that we have here is that in the past, before the harbor management was in place, we simply released these funds through at the time that was the town administrator because we couldn't release them to a non-governmental town entity. There was just no way to do that for us. I think the chair is looking to incorporate the harbor management to a department number with MOCs, et cetera, for spending, for transparency in the future, which I would probably agree with. We used to do that with the Shellfish Commission. We stopped doing that, and I'm not really sure why we stopped doing that, but I'm sure there's some logical reason. But I think on this particular item, I think we have to live with this resolution now, but I think the plan is to incorporate it into the budget as a department with an account code and major object code. So I don't think we can delete this one right now.
So it sounds like there's still some outstanding questions that need to be pursued. The next item, there was a new resolution, Jeff, 13A.
And you can go with 13A or 14 and then change the other numbering.
Describe what it is.
Yes, I will gladly do that. But I think more properly, this will come to us through the Law Committee. I think the Law Committee has been looking at it. For the sake of not being mysterious, I'll frame it. I had suggested some language. It may or may not be the language that the Law Committee comes back with. But the language I had suggested read as follows. The controller is authorized to assign the appropriate maturities not to exceed 20 years on authorized bonded indebtedness to be issued by the town, giving all due consideration in his discretion to all appropriate factors, including but not limited to the useful life of the asset and the then current economic circumstances. The point being, in plain English, that on bonded indebtedness that is approved by the town, the controller should be assigning the maturities not necessarily at 5 years, which in his discretion he thinks is appropriate for the issuance, for the purchase or development of the particular assets involved.
Mason.
So adding that in 13A under general government finance, do you think that is a logical addition there when we know that all the actual bonding resolutions are actually given to us later on in the document? It's doubling up, and that would be my first question. My second question is, this resolution, you would consider that to need 7 members of the board to approve that resolution?
To answer the first question first, just to be logical, the coordinating change will appear also in the resolution that authorizes the bonded indebtedness. That resolution right now talks about issuing bonds with maturity dates not later than the 5th year after the issuance of the bonds, and that word 5th would be changed to 20th. If the controller in his wisdom then, as to a particular issuance of bonds, thinks the appropriate maturity would be 10 years, the controller would have the authority to be assigning 10 years to that portion of the bonds being issued by the town on a particular date. To your second question, if I can, this is intended to be a grant of authority to the controller as a standing authority, which is then approved by the BET and approved by the RTM. It itself is not an appropriation of funds, so it doesn't require 7 votes. It requires a majority vote, like all of the amendments which go into the budget and the related documents. At the end of the day, however, the approval of the budget as a whole, which at that point includes the resolutions, requires 7 affirmative votes. It does not require votes from 7 individual members. It requires 7 affirmative votes. But the bonding authority that has the language changed from 5th to 20th, that's an authorization to bond, and that falls under a different section of the charter. That requires the affirmative vote from 7 individual members of the BET. I hope I have that right, but I think that's my understanding of the charter.
So I also look at this is really a resolution to delegate authority to the controller. He will not be able to assign maturities that exceed what's in the bonding authorization. So while we'll need to get those years to sync, but this then does give him authority to bond for different maturities up to whatever maximum maturity is listed in the bond authorization. That's how I read it. So I don't read it as an appropriation requiring 7 people voting for it on this particular resolution. Right?
I never considered an appropriation. That was language Mr. Raymer had added. I just want to be clear. So you want 2 different terms. You want 20th year in the resolution for borrowing, and you want a discretion. So how would you depict that to the public going forward in the time of the budget? So how would you ask the RTM to know we're going to buy a X? How would you explain to the RTM in your budget schedules that I think we're going to talk about today, well, we think we might borrow that 10 years. Well, no, we might borrow that 15 years. How would you have that clarity there? How would you communicate to the residents what we're doing?
Exactly the same way in the sense that we do now. We authorize bonding, but the controller doesn't go out and sell bonds for the full amount of the authorization on day one. He goes out and sells bonds as he anticipates the funds are needed over the upcoming period of time. It would be useful maybe for me to rely on the much more practical experience of Pete Mynarski, if he's willing. It was my understanding, and Pete would be able to tell me whether I have this correctly or incorrectly, but it's my understanding that most towns, Greenwich having been the exception, in most towns this is exactly the way it's handled, that the controller determines the maturities on bonded indebtedness, coordinating them essentially to the useful life of the asset, maybe other factors sometimes too, but principally that. Pete, can I borrow on your expertise? You have a lot more expertise than I. Would you assist me, tell me if I'm matching up well with your practical experience?
Except for the use of the term controller, some towns don't have controllers. It could be a director of finance, it could be another title. I'll stick with Connecticut. The accepted practice is useful life. For example, a school would be 20 years. Field, artificial turf field, if it had a warranty, for example, of 7 years, you would amortize it over 7 years. There's guidelines as far as useful life. You structure the issue, for example, would be a category for 3-year life, 5-year life, 7-year life, 10-year life. Then you would structure the amortization to tie to the useful life as to just a blanket 20 years, like we did with Nathaniel Witherell and the sewers. That answer your question?
I think so. I'd be more interested in whether or not Mr. Mason is satisfied with the answer, because I'm really relying more on Mr. Mynarski's practical experience. It's my understanding, as I was saying, that this is the way in which pretty much every other town besides Greenwich has been handling it, because Greenwich was a little unique in having the rigidity of insisting on 5-year maturities only.
Let me add something, because Mike, I understand your point that you want to be able to have clarity with this budget document with those people who, one, will be voting on it in the RTM, and the public who may look at it. Right now, we have in here a capital schedule, a capital model that does show, I think, the controller's expectation of how we would go out to the market. It includes looking at annual appropriations, subtracting the excess of debt service from that number to say that those projects will be funded by cash, and the rest of the funding is by band for 2 years and then 5-year bonding. If we move to longer maturities where there's some flexibility in that, then it will take a little bit more thought to develop that capital schedule to determine what it would look like. But I think in explaining the budget, we would say this capital model that's in the budget book is our current expectation with what we know now of how that bonding authorization would play out in terms of financial implications. Did you want to add?
Just a little bit of clarity. You have the bonding resolution in the beginning, 13A, which might become 14. The ones in the back are specific to a tranche, a group. Let's say, for example, $38 million that's in there. It applies to that group, and that goes along year after year after year. My question is what happens in January of 19 to all the existing capital projects that are out there? And does the first resolution apply to everything that's out there?
So yeah,
Because the bonding resolution in the back is specific.
it's specific for the new appropriations included in this budget.
So my question is to the first resolution, how do I handle that in January of 2019? Does that mean that you need to adopt a resolution that retroactively?
Right, so I think there are two things here. The answer is yes, if we were to go to longer-term maturities, this board would have to make a decision. Does that apply for only appropriations going forward, which means we don't see it in the model for 3 years? Or would it apply to previous appropriations that have not yet been bonded for 5 years? And we have to make that decision. If we go forward with this, and we do want to include prior appropriations, it will require an additional resolution in here to ask the RTM to revise the terms for previously approved appropriations. So it's an extra step, but I think there are two different decisions that our board will make. One is, are we even going to 20 years? And then second, which group of projects is it going to apply to?
All right, so I inquired of Robinson and Cole, and it probably presents a situation where you would need a third resolution. And the third resolution, which has already been crafted, is it takes all the existing projects that are covered under a whole series of resolutions, which are under the 5-year rule, up to 5 years, and it can retroactively, this is the third one, nobody's seen this yet, other than Roland and I and the bond council. It would allow you to, on January 19th, if all of this is passed, to go to up to 20-year bonding, under my discretion, up to 20-year, January of 19. So
we have that ready to go based on how the deliberations of this board.
it would be,
Full board.
let me just, if I can go, do you think we can incorporate the third resolution with the 38 million, the existing one, or would it be a standalone for retroactive?
That wouldn't go, the current one would go through 20 years.
But what would we do with the existing
I
ones?
think we need a separate resolution.
Separate?
I would have
Okay.
a preference for that, too.
Yeah.
All right.
I-
My question, I'm sorry.
No, I'm sorry. I should be listening to you rather than vice versa.
It comes from Michael's question about being a duplication here. I'm a little bit confused as to why you need the first resolution in the number 14 or 13A. Because
So-
aren't you accomplishing what you're trying to accomplish with the 38,385 up to 20 years with my discretion? And then the second or the third resolution is catch-up.
The bonding authorization resolution doesn't say anything about your discretion. The bonding resolution simply authorizes the town, to use your hypothetical, authorizes the town to issue $38 million worth of bonds at maturities not to exceed 20 years. That's all it says.
Okay.
So it doesn't purport to make the decision what proportion of that should be at 5 years, what proportion to 10 years, what proportion to 15 years. So then we haven't solved the question of who makes that decision. I was frankly trying to take the BET out of the business of making that decision, if for no other reason than because we have no spontaneity. I thought, frankly, the decision would be better be made by you or by whoever occupies your position of authority as the years go forward. I was only thinking prospectively for the bonded indebtedness that we're approving in this budget year. If we're going to be looking back at prior years, I think that needs to be a separate debate. Different people on the board may have a different feeling about whether or not we start to change maturities on bonded indebtedness that we approved in years past but haven't yet sold the bonds. I think that's a separate question, and I certainly think, as Mrs. Moriarty was saying, that should be a separate resolution to be good and clear of what our intentions were.
Let me just ask a follow-up question on that, because is the delegation of authority to the controller something that's required by the RTM to approve, or is that really the BET's authority to do, that it's not really?
Yes.
No, but we're approving borrowings in the resolution for the borrowings. The execution of that approval, isn't that within the BET's authority and how it gets executed? Right now, with 5-year bonding, there's no discretion. Everything is either cash or 5 years. We're not doing 4-year, 3-year, 2-year. So we don't have the current issue of who's making that decision and when. I just don't know if that's an RTM delegation of authority versus a BET delegation.
I think the question, forgive me, but I think the question is academic, because if you put the delegation into the resolutions, and the BET approves the resolutions, and the RTM approves the resolutions, and the resolutions each contain the new paragraph 14 that authorizes the judgment, the decision to be made by the controller, then the delegation, the authority has been approved by both bodies.
I just don't like to, if we don't need to cede the authority to the RTM, it's something the BET can do, I'm not sure why we would do that, but this is a small point.
I don't actually think that that a delegation to the controller to make the decision of the length of the maturity is an appropriation decision. I think the appropriation decision is implicit in the bonding resolution itself, without the paragraph 14 resolution. But I think you're a whole lot clearer with the RTM, especially assuming there's support for this, especially on an occasion when the town for the first time is leaving its longstanding traditional role of a rigidity to 5-year maturity. I think it should be good and clear to all the parties involved of exactly what they're authorizing and what's going to be coming. I would favor it.
Ms. Tarkington?
Yeah.
Yes, Ms. Moriarty. When I saw this on the agenda, I thought we were going to be handling resolutions as we've always handled resolutions. They weren't ready when we had our decision day at the, Budget Committee. And so the Law Committee has now met, approved certain resolutions. Admittedly, they weren't on the TV camera. However, they approved them, and it would be my understanding, we've always respected other committees, and I see Chairman Crumick is here, as well as the other member of the committee, Ms. Fassi-Lotus. So, again, I thought that what we would do is basically look at the resolutions and approve them as they were presented by the Law Committee. And, and there are additional resolutions. This just doesn't happen to be one of them. So I'm very surprised at this conversation. After we go through the process and accept their report and accept what they've done, perhaps Mr. Raymer would like additional time in front of the camera since he's running for the chairman of the DTC. But quite frankly, I think it's inappropriate.
Point of order, please refer your comments to the business of this committee only.
Okay, so the business of the committee, the rest of the comments were all about the business of the committee. I mean, we've always respected the other work of the committees, and we do have, as I understand it, and you could ask Ms. Crumick, a set of approved budget resolutions, which would be then very appropriate for us to consider the package as they've approved it.
Let me explain. I put this item on the agenda at the request of another committee member. I think that if these issues are going to be debated at the full BET, it doesn't hurt to have some preliminary conversation at the Budget Committee level. We didn't have it during their budget meetings, and so this issue was coming up. I think it was a specific one of interest to discuss and to look into a little bit, and that's the only reason. I don't plan on voting on resolutions today. I do think that's the purview of the law committees, but it's an opportunity to review the changes.
Well, I must say, I think in many years, the Budget Committee has approved the resolutions when they've been available. I think last year was maybe an exception. But we have approved what has been presented by the Law Committee. And we do have a set of resolutions from the Law Committee. If, after we go through that process, Ms. Moriarty, you want to take up additional questions that have come to you, then that's certainly something that we all should do.
Thank you for your input, but we'll proceed as I'm proceeding. Go ahead, Mr. Mason.
If I may, to Peter Bernarski. So if I'm understanding, try to get a visual of this. The budget's approved in May, presumably by the RTM, certainly by May 15th. There's a budget that goes forward, no matter what. In that budget, there's resolutions. In that previous to today, to this conversation, there's a known borrowing term. We borrow to meet cash flow. We borrow in tranches for capital projects. Am I correct?
Some are borrowed, some are cash.
We
Yes.
borrow in tranches to meet cash flow needs on big
Correct.
capital
It's
projects.
tied to cash needs.
Okay. So I think what Mr. Raymer's doing is he's He's working around a section of the charter that has to do with the authorization to borrow. So now what we're looking at is the authorization to borrow would be postponed until January. Right? Because you'd have this resolution, so after the budget was passed, if this 13A, 14, whatever it's called, this happens, we now get to January. And what happens if you fail to get the authorization to borrow from the BET then?
No, it's not what I'm anticipating, but I
For
don't
the
mind.
38 million?
I don't, the number's not relevant. My point is,
No.
let me get to my real point. If you're about to borrow $38 million in your book, that's presumed, okay? Let me
Up to
just-
$38 million.
Up to $38 million based on the cash flow needs of the town.
Correct.
What happens if you don't get authorization to borrow that come January? Because we don't, remember, if we're borrowing in tranches, and I presume now you're going to discontinue borrowing in tranches because on certain projects, because you now have the ability to go 20 years. So the problem is you now have to borrow in full. So let's just take, let's take a project that might be coming up. Let's take the funding away from New Leb for a minute. Let's say that was just our project. So you would, under this scenario, you would no longer be borrowing cash flow. You would have to borrow for the entire project because you couldn't do New Leb project and borrow for, say, a third of the project this year for 20 years, a third of the project next year for 20 years, because you'd be exceeding the 20 years by statute, correct?
Yeah.
So what I'm saying to you is, this is very, very important. We borrow to meet cash flow needs. When we appropriate something that's going to take us a couple, 3 years to build, construct, do whatever we're going to do, we borrow in tranches to meet the cash flow need of that project. So that would be another complete change in how we would borrow. You would have to borrow the whole project up front because you wouldn't be able to do a 20-year borrowing followed by the next tranche being 20 years.
Why not?
Because you cannot borrow, a municipality can't borrow on a single project for more than 20 years.
Can I speak?
Well, actually, they've changed that. You can go up to 30 years.
I'm sorry.
now. But-
Okay.
But is your question is if this resolution
How does it-
fails, you don't have a funding source?
Correct.
That was your question, right?
Somewhere along the line, I know it seems to me, my visual, and maybe I have it wrong, is that we are moving the decision to authorize borrowing to a time and a place when we've committed to projects, so there can be no way, because you would be presumably appropriated without funded. And that's what I think the intent here is to do. It's what I would say a different look at the charter. I don't, obviously, there's no support. This is a major change in budgeting process, not the term. That's not the change. The change is, what are you going to do when you get to the point where you need authorization to borrow and you're fully committed and you don't get that seventh member vote to change the borrowing to authorize the borrowing? What do you do then?
I think, I might have misspoke. I think what would happen is if this resolution fails, they all become, the whole 44 million becomes cash. You'd have to pay cash for them because you've appropriated, and only a portion of them are paid through cash. So if you don't have a funding source from borrowing, you'd have to come up with the cash for the whole 44 million.
So to continue on, then it would be wise for the
Sorry,
town.
46 million.
It would be wise for the town, at the time it's appropriating, to have an agreed, authorized borrowing, so you have the cash to cover, at the time you make the appropriation. Thank you.
Mr. Raymer.
So two questions were involved, if I understood Mr. Mason correctly. The question becomes, what if there is not a seventh vote, a vote from a seventh member to approve the bond authorization authority? And the answer is, then you don't have the power to bond. Then the failure of the seventh vote means that you're obliged to either not do the project or do it in cash. I think that's a given. It doesn't matter whether you're talking about 5-year financing or 1-year financing or 20-year financing or even 30-year financing. Without bond authorization, you don't have the authorization to bond. And so if 6 members of this board chose to block the bonding authorization, they could block bonding authorization. It's as simple as that. Whether or not they wish to do so is another issue. Pete, if I can take your attention here for a second. I don't think that my colleague had it quite correctly. I believe the statutory constraint is on the length of maturity of the bonds that are issued. So if you have a bonding authority and you wait, and your bonding authority, let's say, is for 30 years, and there's a statute that says the maturities are limited to 30 years, if you don't go out until the second or third or fourth year before you sell bonds, you're not constrained from issuing bonds at the maximum period allowed by the statute. The period of time doesn't run from the date of the authorization or even the date of the beginning of the construction project. It's a limitation by statute on the length of the maturity of the bond that you're issuing. So you could go out and authorize a bond issuance, and you could fund it in 3, 4, 5, or 6 tranches, to use the expression that was being used, of financing. I'm not saying that I would recommend they all be of 20-year lengths, but they could all be of 20-year lengths. And indeed, the payment of the last bond would be more than 20 years after the date of the original authorization, more than 20 years after the date in which you put the shovel of the ground. It would be more than 20 years after the first payment that you made of the first bond in the first tranche. The only limitation is on the length of the maturity of the bonds, and you're not limited from doing the tranches. And so I'm not sure that I understand my colleague. I understand my colleague's point about not having 7 votes to support a bonding authorization. Boy, he makes that point very clearly to me. I've got that point. But the point that he's making about the inability to do tranches, I don't understand that at all.
Okay, so I think on this particular resolution, we understand the issues here. It's tied to the debt model that we, as a board, will try to agree upon, and we'll see how that goes forward. Moving to the next one, Senior Center. I wanted to ask Roland if you could follow up. I know that during our budget deliberations, so the Senior Center resolution number 21 is being modified to take out the dollar limit and to tie it to the renovation project. And we did have a question when we were discussing this particular project with Mr. Minnelli on what the status was of the public-private partnership and what the expectation was of what's it called? Friends of the Senior Center, Friends of the Greenwich Senior Center. And he had an update for us, which we never made time for in our meeting. So could you get maybe a written update from Mr. Minnelli on what the expectation is currently for the contribution from the Friends of the Greenwich Senior Center towards that renovation project? I think it may impact, and if Beth, as chair of the law committee, if there's information that you have that will help us in our discussions, please feel free to let me know, and we'll recognize you. But I don't know if it affects the wording of this particular resolution.
The best information right now is from the Senior Center, who is working with the Friends.
Mm-hmm.
How much money they've raised. I think they have $400,000 available at this point.
Okay.
Maybe the memo should come from, maybe the report should come from Laurie Contadino, the head of the Commission of Aging, or Senior Center, I'm not which, but I think she's got both jobs.
Right, because I thought I heard something that there may not be additional contributions, and now I'm hearing there are, so I just...
They have commitment for 1.2 million.
Okay.
They were anticipating another couple $100,000.
Okay, good to know. So I think then the resolution is modified is probably, I don't know if you approved it, but it probably is more reflective of the expectation for this year versus the wording that we had last year.
Are you asking Roland to get a report from Laurie Contadino?
I think that would be helpful, right?
I think it would be.
So, Roland, if you could follow up, thank you. On the same issue?
On the same issue.
Okay, sure.
Especially the same issue, sorry, maybe I don't want to give you. Roland, on these changes, when the Budget Committee comes forward and proposes the changes, which we've already seen by email, a draft of them, could we get a reprint of the resolutions with the modified ones in bold print?
Once we have them all, we'll
Okay.
put them in.
All right, thank you, sorry, thank you.
So I think the next change was under the police department. And as I read the requested new resolution, it was to be able to utilize grant funds from the forfeitures and the state statute to use it for training, subject to our approval. So it would be the same process we go through now. It's just the RTM is delegating that approval to us, so it wouldn't go to the RTM.
Except that right now, those revenues are in our budget under, the police revenues. And this resolution then would require us, if we propose to approve this resolution, which was not approved by the law committee, and Ms. Crumick can, give us an update, would require us first to reduce the revenues, police department, and I don't have my budget book, but the line number, I think I looked up this morning, and by $50,000. And, if you look on the actuals, you'll see that it was just over $50,000 in fiscal year 17, which is our last actual year. So those would have to be removed, and this would then take that money and only be used for training when the police department already has a training budget, and this would basically increase the police department budget by another $50,000.
Mr. Mason, you had a comment?
My comments are obviously to this resolution, but not really police. So during budget deliberations, a statement was made about departments trying to grab revenues, make them appropriations to spend on particular items that are pertinent to their department. I get it. What I'm a little bit nervous of, in my brown-haired days on the BET, we took all of grants that came in at the time, received them, appropriated them, the department could spend it. We said, okay, this is common practice, so we just plugged the grants in and said, by the way, department, if you get them, use them accordingly. That's the changes we've made over the past decade or so. Board of Ed's a great example of that, all the ECF, whatever they get. The problem is we never got to a point where we thought the grants would sort of disappear. My question probably is for Roland. How does this, so let's just use the police department to make this simple. They get 50 grand in for training. They drop it in a 100 MOC, right? They get it, they drop it in, they're authorized to spend it if we release it correctly?
They would need an appropriation.
Okay, so we would take the grant, $50,000, we would make an appropriation, that would give them a revised budget.
Right. Now, if we were, it would be just like the other grants that they have, asset forfeiture, things like that. The difference is this has been running through the general fund revenues. If we were to set it up today, we would take those grants, never report them to the general fund, put them into the grant fund, basically a triple R account.
Yep.
And that would go forward just like we do with the other grants in that fund. But we have been running this through revenues. So if you allow the police to spend this, I mean, we would move it over to the grant fund, but you'd have a $50,000 hole right now in the general fund. That's really...
So the question I have is, so we get this $50,000 and we make the changes that you would like to make. How do we, next year's police budget...
It wouldn't be in next year's police budget.
It doesn't roll up. How do we stop that everywhere? I mean, because there's all kinds of departments.
Well, the police has a lot of different grant sources.
But
right now
health does.
Health does. They come in and they ask for permission to use it. They ask for the appropriation to use the money that they've received.
What's the benefit to, I guess, first the police department, and you've explained the impact to us as we now have a $50,000 reduction in revenue in our budget, but the expenses are still there.
Well,
so we would remove the expenses from the budget too?
No, what the police would say is those expenses are not in the budget, that they would use that $50,000 for additional training above and beyond what's in the budget.
Incremental.
These grants, when they're used this way, have to supplement the budget. They can't replace the budget.
So, so what's the benefit from the police department side? What's the benefit to them to
They have
doing it this way?
$50,000 of additional funding for training at this point. They said they would use it for training, so they have $50,000 of training that they don't have in their budget right now.
But they would only get it if that funding source came through.
Yes,
And if we appropriated it. This
Right.
grant is, that the resolution's written that we need to appropriate it. So we could always not agree to appropriate it, but receive the grant. But is this an issue that just came up for the first time this year, that they're
It-
asking to do it this way?
it is, because we've been receiving this money, and it's just been general fund revenues for many years. And then they tried to use it last year in one of the grants where there was a contribution from the town required, sort of a 80-20 match or something like that. They wanted to use this, and we talked about it. So you have no resolution to be allowed to use this, for one thing. So now they came forward with this resolution.
Go ahead.
I'm wondering what is the need for the resolution, is what's disturbing me. We had the experience earlier on. Leslie and I dealt with this at the Law Committee a number of years ago. I was thinking maybe that's what Leslie had going on in the back of her mind, relate to insurance proceeds. And at that point, I think it was the Trees Department wanted a resolution that said that any insurance funds received from damage to trees would have to be used to buy replacement trees. And we didn't approve it at the time. Matter of fact, the BET didn't approve it either. The point being that if we suffer a damage to trees, we receive an insurance proceeds, it ought to be a financial decision of the town whether they want to use the money to buy trees or something else. I'm not sure that that's precisely the problem here, because I think these police grants don't come to you in a way in which you're free to use the money for anything else except this. But frankly, if the way the resolution is written, if they have to come back to the BET anyway, what purpose does the resolution serve? In the off chance that I have any portion of the grant funds which might not necessarily have to be used for the specific purpose of the police work, I'm not sure that I want to make the commitment that any funds coming through police grants will necessarily always be applied to expenditures of the police department.
Well,
What purpose does this resolution serve, is the question.
What this does, it gives them access to this $50,000.
Another 50.
But when a grant is offered to them,
Well, this isn't really it's a little bit different. This is our share of parking fines.
Ticket,
Or
moving
tickets, moving
violation.
violation.
Moving violations.
well, it's also forfeitures. It's the getaway car, which is impounded and sold at auction and whatnot. I mean, it's other funds as well.
That's a different grant, and you already have a resolution. There's a state and there's a federal asset forfeiture program. They're already in place.
This one says fees, fines, forfeitures resulting from criminal violations. So it sounds like it's partly the forfeitures too. I'm just reading from the resolution itself.
What we get is
Moving violations.
moving violations in that $50,000.
It's actually more than that, the statute actually is more than that. Criminal reimbursement, there's another program. Primarily moving violation, I would think.
So looking at these two very capable people on the law committee, maybe they can help me out. If they have to come, if under this resolution they have to come to the BET anyway, what purpose, what need was there for the resolution? You didn't see one, is that what you said?
Yeah, we did not, we didn't approve it.
Neither one of you? Wasn't a split vote, it was a 0-2 vote. Okay. Okay. Well, that's very educational.
Because it's coming through the general fund, and there is a line item in revenue for the police department, for these monies.
So then picking on poor Roland, who now has to pretend like he's wearing the police uniform. Roland, from the department standpoint, because I appreciate the department isn't here, why are they asking for this resolution if they have to come to the BET anyway?
Because this would be a source of funding for them. They can say, look, we have $50,000 that's sitting here. We want to use the $50,000.
And why does that not happen if we don't pass the resolution?
Because basically, they can't use it for any purpose, but if you did say, yes, you can use it for this purpose, you're basically reducing general fund revenues by $50,000.
And also, right now, their training programs are also sort of probably umbrellaed by the HR department, and this would create another pool of $50,000 that they could use. I was looking at, they get payments for college credits of $136,000. They have other training, and so forth in the budget, and this would just add another pool of $50,000. But again, if we do this, which the law committee has not supported, we will have to, if we want to have the same kind of budget, we will have to find another place to reduce expenses by $50,000, because this money will only be earmarked for a special fund for additional police training.
Well, they said that's what they would use it for. They could use this for anything that's approved by the state to use these for. And
Not with
what
this
came up
resolution.
what came up last year was they wanted to use this, I forget what they wanted to purchase, but it was a 80-20 matching grant, and they wanted to take the 20% that the town had to match from this pool of money. So they could use, it's not just
But
training.
the way this resolution is worded, they could only use it for training.
Well, that's the way that the statute that they reference it.
Okay. So in theory, if we reduce the revenue, we could also reduce, or should also reduce 50,000 from the police department training budget, whatever, if there is one.
They would say that you
This
can't
is-
use these monies to replace
Right.
things that you budgeted, that this would be in addition to the training money
Okay.
that's in their budget.
All right, so I think we understand the issue. I think we all have to think through whether we support it or not. It's one of those items probably that stems from our budget guidelines of being that we've increased budgets lower than the GWI of labor contracts, and everybody's looking for additional sources of funds. So the next one, Public Works.
Well, I would just like to, I don't believe that that's a correct statement, is it? I mean, right now, I think the CPI is lower than the amount that we've increased it, which is 2%, and the CPI is lower. But I said, potentially, you may be correct if inflation changes, but
I'm
not at the
saying
moment.
Our labor contracts, though, are mostly settled above CPI.
Right, but right now, we put in the budget, whatever,
Right.
2.4. We
So-
budget all those separately.
Number 36, I think, is bolded in our books as a new request, and that is for the DPW to accept proceeds for their overtime labor costs that they do for inspections, and to have that approved and allocated to them, not to exceed their costs. Any discussion on this particular one?
Explain it.
So as I understand it, for example, if somebody's putting up a tent on a Saturday, they often will not, the individual will not decide to do it until late Friday night, waiting to see what the weather is, so they don't incur the cost. It requires a certain size, requires inspection, so our guys go out on a Saturday, they get overtime pay. Right now, that the funds or the collection, actually, we don't collect this money right now, I don't believe. Do we collect fees? We don't collect fees for this overtime service, so it would be able to assess fees on that individual, have it collected, and have it go into the department's account to cover their expenses. Beth, do you want to clarify?
Is this that the Board of Selectmen would have to also agree with that overtime could be charged, because they set fees.
Right.
But the feeling is if you are incurring that overtime or those overtime hours on a weekend, that there should be an account that can be placed into. And that's, so the law committee was more interested in seeing this one go forward.
It would go in there overtime.
Mike, I think, had a comment.
Why would we not just increase the permit fee to cover the cost of this and keep it simple?
That's, I think, what would happen, but where that differential, where the money would go would be into the overtime.
So,
Either the overtime account or a separate line item.
so
The ruling.
Do they currently budget for that overtime? So it must be in their budget now.
I think they're saying they don't know what it is, and it can run over from what they budget, so they would like to do what other departments have been doing. Say, I don't have to worry about this, I won't budget it, and if I expend it, I have a funding source to reimburse myself for it.
The other thing is that when Ms. Moriarty and I met with the DPW commissioner, she did comment that this is similar to what's being done in the Parks and Rec and the Board of Education, where they have, rent facilities or whatever, they can charge through the overtime, and then that obviously feeds their overtime account. So this mirrored a practice that's being done elsewhere. Quite frankly, it makes sense to me, because what we learned was that this is becoming more and more of a problem as more and more people have tents and so forth on the weekends. And it's a way of covering costs that at the moment can't be planned for.
Just to add, we did propose, because they don't seem to know how often this happens, that we get an annual report itemizing the proceeds, because with the thought that we ought to see what in a year we're talking about, we get a benchmark, and then we can decide next year, yea or nay, to keep it in, take it out, because we give us some control over learning more about this area.
Mr. Mason?
Parks and Rec, first of all, schools are different. Schools' fees, they get when they rent the facility. That's a different animal. Parks and Rec has got a fee schedule for everything. DPW probably doesn't have a fee schedule for this. Probably never came to the Board of Selectmen. But if they do 10 permits and you call somebody in on a Saturday morning for a inspection of a tent, I'm going to use your just so we understand, they get 4 hours, a time and a half.
Right.
So, and that's by contract. My feeling is we should just add it to the permit fee, because otherwise, they do a bunch of these, they've actually added to their MOC at the end of the year. You've actually increased their spending every time you do a permit, and they're already doing this work currently. They're doing it today, they did it yesterday, they did it last year. So I like the idea of reporting it for a year, maybe do this resolution next year, but right now, just incorporate it in the permit fee. If it's 4 hours, whatever the rate is for the inspectors, just add it to the permit fee. The Board of Selectmen should do that.
So I guess you have differential permit fees if you're doing this during the week versus doing it on an overtime basis. I don't know if it gets complicated
I
as to
wouldn't be
how
worried
you
about
set
that.
the fee.
Or Saturdays and Sundays.
They're two different issues.
A lot more than it used to. That's why.
But I'm sort of in the.
Roland has some
I'll
to share with
let
I
us.
should have probably looked at this earlier. They've been budgeting about $38,000 a year for overtime in the building department. They're spending 16. So it's not like they're going over their overtime budget.
Right, so this would add to that, in theory.
The critical piece for me is the point that Mike was making, that with this authorization, the funds that are generated become an additional salary appropriation for them to use in the 100s line. And I think that we make an appropriation. That's the figures for them to work with. Because they've had some exaggerated number of tents or something in a given year, they're overspending that line and want to come back to us for an interim appropriation and explain to us why, that's fine. But the problem with this one isn't whether or not there shouldn't be an adjustment of the fees through the Board of Selectmen. Probably there should be. The problem here is that I don't want to approve this because I don't want those funds to go to their salary lines in addition to the dollars that we appropriate, so we lose budgetary control over what they're spending, especially in a setting in which they're not overspending their overtime budget right now.
Unless we reduce your overtime.
Again, what the commissioner said was this mirrors number 47 in Parks and Rec, where they can get to do that. Such proceeds shall become appropriations that the controller shall add to the appropriate accounts for the purpose of reimbursing the approved costs related to the rental of, so it includes the people and their overtime and so forth. And that's what's happening. And obviously, again, what we were told was that this is becoming more and more of an issue, and they can't,
All right, I think we have the information on the
Right.
table. I don't think we're
Parks
going
and
to
Rec, you're
decide this
renting a
in now.
facility, though.
I mean, there's a
fee for that.
If the town isn't charging for this overtime cost, then as Mike's point, there should be consideration of how do we charge for it. We can decide whether the money gets put into their budget or whether it goes into a revenue account, and we ask for a report, and then maybe we see, next year how much of a problem it is. But it looks like they've budgeted for the overtime. They just want to change their methodology going forward, but they're only changing the one piece of it, the revenue side, not the expense side. Okay. The next item are in the Board of Ed resolutions. We got a request from the Board of Education to modify C, which is to,
I think the number might be wrong.
the grant, right now, it says that grants that are not listed above, up to 5,000 are delegated to the Board of Ed to spend. They've proposed increasing that to 25,000.
What was the reason?
Oh, I see, it's changed.
Changing the number.
Is that right?
I think the rationale is materiality, that the size of their operating budget or their budgets and the number of grants they have, it just is more in line with the operations needs. Can I ask what the law committee?
We split 1-1.
Okay.
For this one, there was some concern as to whether, if you went back to the charter and the ordinances, there are a number of places where 5,000 is the limit before it has to go to the RTM. And that there was a question of why we would increase in this area.
Mhm.
Can I see
That
that
was
resolution?
That was
The new one?
balanced by the thought that 25,000 in today's money is probably a more realistic number than 5,000.
Yeah. I also think there's an issue, Board of Ed, when we think about a 5,000 grant to Parks and Rec, it's a bigger significance in their size of their budget. Board of Education is half the town's budget, and 25,000 is probably, over time, maybe more appropriate given the size of their operations. But what these resolutions do is ask the RTM to give that authorization already. So while the charter does have 5,000, these resolutions are looking at the charter provisions and asking for special or different considerations.
So, again, I would ask, how many did they get?
So we can take a look at our records, how many grants. I know there was the Asian grant that always comes through. I don't recall how many others. Do you know offhand? The COO of the Board of Ed is here.
I sent a list out to everybody that showed all of the entities that were in Board of Ed grant fund and the town grant fund. And
Do you have information?
Yeah, I mean, we went back and forth and found, not necessarily year to year, but we did find at least two to three grants a year that were completed.
By how much?
I don't recall. I remember there was a road program, the Asian Institute,
If you can get them to quantify it, but, you know,
Yeah, all right,
you're
so-
going up, you know, from 5 to 25, your notes are there for 50. I mean, I don't,
Well, I know that the Board of Ed, which approved the changes to these budget resolutions, was discussing 50,000. I think the documentation that came to us was 25. Then they settled on 25 as their request. So maybe we can ask Roland either find that chart again.
I've got it here.
Okay.
what's the date on it?
This is,
The date of the email.
The date of the email.
I'm just looking at the insurances.
yeah, that's it.
It says, okay.
That's 2 years, and then the details behind it.
Okay, so it's 7,674,000 and change in 16, 17, and then the year prior to that, 11,754,000.
That's total, everybody.
Let's tell everybody.
Those are
What was the date of that
substantial
email?
amounts. Pardon?
What was the date of the email?
It may have, let me just see who it went to.
Was it from you,
It was-
Roland?
It went to the law committee, so it was March 6th, so let me, right now, I'll kick it over to everybody. All right.
It'd be great. Thank you.
All right, so again, we're trying to identify the issues that these members might have as we consider these resolutions and over the next couple of weeks leading up to our final vote. So we'll look for that additional information.
So may I ask a question?
Yeah.
As we consider these, one of the things that we've done is the expectation that if it relates to the hiring of personnel, that the grant money also account for the other fringe benefits and so forth. So, if we consider increasing this, because I would think that would open up the field, maybe they'd be looking for other ones too, should we be making an affirmative sentence that it's expected that if the grants are used for the hiring of positions or something, that the costs of all related employee benefit costs will be included, or something on that end?
I want to look, I know that we have that understanding now. I know it's written somewhere because I remember reading it. I think it might be in our reference manual, I'm not sure, but I'd want to look at where it is now to see whether it's appropriate in the resolutions or not. That's just what I'm thinking.
But we could consider that. As your volume gets larger, people may not, maybe it goes to individual schools or something that may not be as familiar with the town's policy.
Okay. And then the Board of Ed had a new resolution that was, I think everybody had gotten a copy, but it was basically asking for authority from the RTM to be able to utilize non-federal government, non-state government grants up to that same $25,000. And their language says they will comply with all town and Board of Ed policies for implementation. Here it talks about, all town and Board of Ed policies and laws and regulations, and that cash would then become appropriation. So asking for that to be utilized and then appropriated for the Board of Ed, and they would report annually on itemizing these grants. Whereas C, that we just talked about, is limited to government grants, they're asking to include this for non-government grants. And I guess that's related to some of the ones that we discussed, 2 or 3 a year. Maybe it's more in that category, we don't know.
We should try to get that info that they had to make that decision.
Right.
Okay.
This then begins to get into issues of who these are, whether it's family foundations or whatever they are, and, how many from a family and so forth. So, I would think that, obviously, grants, I guess, would fall under the BOE gift policy, and, again, I don't know, you would know much more about that than I do.
Yeah, no, I believe it would. Okay, so we're looking for information on the Board of Ed grants that have come to the BET in the past year, 2 years. So we can see the amount that we're dealing with.
And again, I would ask in that same vein as the previous one, that if it relates to the hiring of any personnel or positions or whatever, that the cover.
Okay, and then I just want to highlight, I raised one point which I think was new to everyone, and so on page 11, we have a resolution here about, this is the staffing resolution that we tell the RTM, and that is under its resolve that no department is able to use any funds for staff in excess of the table of organization that's approved in the budget. And I know that this has been a subject between the Board of Ed and the town and the BET for several years, but I believe the understanding is that certified staffing is not within the ability of the BET to control the level of certified staffing, and that our practices have been where we haven't had monthly discussions over the level of certified staffing, and the Board of Ed does change certified staffing throughout the year. So I thought, to be more accurate, this particular resolution should be changed in the "it is resolved" to exempt, or say, with the exception of certified staffing of the Board of Ed. And I was proposing that because I thought that was the understanding between the BET and the Board of Ed. The Board of Ed has that authorization from the state statute to make determinations of how to spend the funds that the town allocates towards education. So I thought it would be more accurate to put it in here. It apparently raised the issue of whether that understanding is accepted by all.
Ms. Moriarty, certainly when I was chair of the HR committee for 4 years, the staffing of the certified positions was handled by the BOE, but the total number was always approved by the BET. So if one more or two more were needed in addition, those positions always came, the superintendent and the, head of human resources always came to the BET to get those approved, even if it was in the interim. But overall, we didn't necessarily say this position has to be at Parkway or whatever the different certified positions are, but it was holding to a goal of positions, certified positions and total positions with the BOE. And but we never really got into the intricacies of the actual position because, as you point out, we don't know as much about the requirements of the certified staff.
Mr. Mason?
Just let me read something for a minute here. I think it's 21 takes care of that for you.
You reading a charter?
Yeah,
Okay.
but I think that's covered
I
already.
think it's covered, but then as a standalone resolution, this is a little misleading for somebody
Well,
reading it.
It has to do with the director of HR. That's where it's actually covered. But I believe that's prescribed by our charter.
Well, then, again, I would say this resolution, we should add that clause if it's certainly consistent with the state statute. And I know that sometimes the interpretation of our charter and the interpretation of the state statute creates some conflict and gray areas. But
I don't think that's what that resolution's about. I think what that resolution is trying to say is, we're presuming this is your staffing model. We're funding it. We're funding those presumed positions, and we don't want you going over that. So we don't want to. I don't want to use the Board of Ed, but I'll use the Board of Ed. So we don't want to get rid of 3 custodians to hire more certified staff.
that's not what this says.
I know, but that's the conversation to go behind this resolution, because these
But,
are.
but that's not what this says, and so what this says right now, I think, is in conflict of current practice, and that, I'm a
Well,
little concerned about that.
I think that the current practice perhaps has morphed to the advantage, but I think that there was a practice that was working very well that did respect this. And, as we've talked about before, there are certain guidelines that the BOE uses for staffing it at schools, et cetera,
Right, and
but they
I
aren't
wanna-
state.
I just want to differentiate, for the budget process, I know we're all in agreement on,
Right.
we accept a TOO at the budget process, but in actuality, as the year goes on and the number of kids show up in September that are different, they do vary from that budget staffing model. They stay within the 101 budget appropriation, but their numbers may change. We know they do the Evolve program, so right there it changes. They hire more teachers and they hire fewer paraprofessionals.
The
Well-
reason that this was put in where it talked about benefits was because at the time that this was put in, certain departments in the town said, I have the money, I'm going to hire somebody. And the BET said, well,
You can't,
maybe we can't stop you, but we're not going to give you benefits. But since the new positions are now all approved by the BET HR committee, I don't know that you need that same kind of reference in terms of benefits and because you already have the control over that, I think.
Right, but what I'm saying is we don't control
Oh.
certified staffing, and that's what should be exempted. Anyway, leave that issue there. I think we all need to think about whether it's appropriate to put in here or not. As a standalone resolution, I think it reads, it could mislead people about certified staffing.
I think Roland's point was that the certified staff, everyone was included in that, because in addition to, I mean, so let's just say the pension funds are outside of the budget, but life insurance and the health benefits and all these different things add up that become, and then there becomes a continuity of these for the future. It's not just today's cost, it's adding this on.
I know what the concern
Right.
is, but I think it violates the Board of Ed's authority given to it by the state statute, which means it's not appropriate. And I think it also, it's not the current practice. And if there should be reporting after the fact, if there should be more information flow, we can work with that. But the way this says is, there will not be any addition to the headcount, period. And I think that violates the state statute and their authority. Okay, let's move on, because we wanted, so that was it for, I believe, what we know are the changes in the resolutions as presented to us and as we've seen. I wanted to move to a discussion of the debt model. As proposed resolution indicated, there's consideration over changing the maturities of the bonding authorizations. And we've always talked about this a little bit in isolation from the numbers. So I put together a few charts that Roland's going to help me hand out here that just gives you information. I'm not looking to reach a conclusion today on this, but I think people should have the information of what the change in debt model does. So start with just handing out the budget book one. Budget book, and then the same as a budget, the 20-year financing with the same budget tax levy assumption. I have one.
Is this the one sorting the budget book? Is that what you mean?
So the first one should say budget book model at the top. Does it say that in the middle? Okay. And the change, what I did on this spreadsheet that's different is I split out, or Roland actually did the work, but we split out Town of Greenwich and Board of Ed separately, so we could take a look at the basic assumption for appropriations to see whether they're good appropriations. We didn't do a discussion on the debt model initially, and you can see the town appropriations stay in that 25 to 30 million range. There are a few bumps for like Eastern Greenwich Civic Center and the skating rink, I think, are the two projects that cause it to bump up. There is one other in there, but they're staying in that range throughout the entire 15-year term. We had put in a plug in that last year because the number had dropped, and that was in the budget book. The second three lines talk about the capital plan from the Board of Education. And here, again, this is the model in our budget book. We accepted, we put in a plug of 20 million for several years, starting in fiscal year 25 to 33, to try to reflect this increased capital plan. Now, some of the earlier years may be a little light, depending on what their capital plan is, but again, the ballpark is this new master plan that they are considering, and I believe our April 5th, I think you're having your work session discussion on the master plan, so that would be an interesting meeting to attend. So total capital projects, then we come down to over the 15-year life of $777 million. The next, so then we go through our normal capital calculations of bands and other changes to that to get to the net capital cost, which increases to $795 million over the time. The next here, again, for interest, I separated our debt service. We usually see that as one number, but I separated it to show interest expense and then principal repayment separately, so we can see what the makeup is of the debt service to get to financing requirements. The tax levy is as is presented in our budget books currently. It goes up $3 million for the next 2 years and then $1.4 million each year going forward. The,
And why did you?
that's just what came forward to us. It was what the debt policy working group had used in September. I think it's consistent with what we used in last year's budget book, and nobody's really looked at it to see whether it needs to be at that level. So it was more that we just didn't change the assumptions.
So what's in the book right now?
This is what's, right.
Yeah, the 1.4 in the out years is what's in the book right now.
Now, on the sheet, I added 3 lines, little 2 lines down from that, the debt policy. So if you remember, we approved a revised debt policy in December. It has 3 tests to see whether we comply. The first test is a percent. It says capital from taxes, but it's just that a minimum of 10% of projects need to be paid with cash out of the taxes. Second criteria was that the debt service should be a maximum of 10% of the budget.
I think it's 11.
That's true, it is 11%. Well, that gives us a little more room.
Yeah.
11%.
The debt policy, I believe, had 11%.
No, actually, it's 10%. It's the fund balance policy that went to 11. So this was 10%. And then you actually have your reference book there.
11%.
It did, even on,
It's 11%.
okay.
Unless,
I know the fund balance went to
no more than
11%.
11%.
Okay,
No, I know fund balance was 11 also.
okay,
I'll double check that tomorrow.
It's right here.
Yeah.
Look at the minutes for.
It's right here.
yeah. So, okay, that's it.
11%.
11%. And then the third one was that total debt as a percent of grand list would not exceed 0.55%. So that, adding it to this chart, we can see what happens to our criteria as we change assumptions in this debt model. So you can see that we, even with the tax levy that we assumed in our capital plan, all of a sudden our percentages get very healthy. We're paying more and more out of cash because our debt service is being retired. But that's the starting point. The second page that was
Can I go back a step there?
Sure.
On this total debt percent of the grand list, as I remember it, this was the equalized grand list.
It is the equalized.
And so then when we go to
I'm not sure that's
fiscal
right.
year, so it'd be fiscal year 21, 22, what is it?
No, excuse me, it's not the equalized grand list. I'm looking at the debt policy, and we had that conversation, and that was a source of discomfort to you, Leslie, and the assessor agreed with you. And so we said, as certified by the tax assessor.
Okay.
It reads, maintain a maximum town net debt of no more than 0.55% of the most recent grand list, full market value of the town of Greenwich as certified by the tax assessor of the town of Greenwich.
Thank you.
Not the equalized grand list.
Yeah, I think that's good because.
And for the purpose of this model, we assume that the grand list increases a certain percentage each year. I can pull it up. Do you remember the percentage used?
So Roland and Leslie, the next time you run this, you know, if you could just put the grand list assumption on here too, another row for that, at least we'd be, you know, have a feel for how one is growing versus the other.
It's 0.3% is what, it's, every year it's 0.3%. And the operating budget assumption is growing at 2%. So again, that's, you know, embedded into the line 2 calculation.
Thank you.
So that's the starting point. I wanted everyone to look at that. The next page shows, if we go to a 20.
I don't have a next page.
So then hand out the 50% 20-year bonds with the tax levy increasing. So the same assumption as the budget book. So at the top, it should say 50% of net capital, tax levy increasing.
Gonna get your reading glasses, Roland.
No, that's flat tax levy. I tried not to do too many to. Yes, that's the one. Because I didn't want to change, I want to change only one assumption so that we wouldn't get confused as we go forward, but we can look at the implication. And then you can hand out the.
Do you have a lot of extras? Would you give them to Karen and to Beth?
Yes, she is.
Oh, you did? Oh, sorry, okay.
So on this page, the assumption here, and this again was based on, I think, on Roland and Pete's advice, that 50% of the capital appropriations that that are in that fiscal 19 would be funded at 5-year bonding, and 50% would be funded at the 20-year level. And the assumption being that not all of the appropriations we're making are eligible for the 20 years. It's not the life of the asset. So let's try to get a little closer to the life of the asset, and that's really the concept that we're talking about. And what you see here, and Roland, if you can hand out the 8.5 by 11 sheet, the comparison makes it easier to see on this page.
Thank you.
So this just runs the same way. We're using the same tax levy assumption, the same interest level, interest costs, the same general fund. So on the smaller sheet that summarizes the bond, the interest expense and the principal repayment, you can see that on the 5-year bonding, we're paying $52 million in interest over these 15 years and $519 of principal payments. If we use the half 5-year, half 20-year bond assumption, we're going to be paying $72 million in interest, but only $398 million of principal costs, what you would expect. And you can see the variance that we see. So basic outflows from the town covering debt service over that period are $112 million less. There's a model which Roland will hand out later, but that shows, you can see in the first 4 years there's no difference, and that's because in this first assumption for the 20-year bond, we said it was only for the fiscal 19 appropriation. So we're going to do 2 years of bands and then bond it at the end of the next year. So you have no change for 4 years, or 3 years really, as we go forward.
So can I ask one question?
Sure.
So you still plan to do 2 years bands and then 20-year bonds?
Yes.
And so, may I ask a question?
Yeah.
Pete, now when we do 20-year bonds, as an example, for Witherall or in the sewer improvement fund, are we doing 2 years bands and 20-year bonds? We're doing 2 years bands plus 20-year bonds with both Witherall and with the sewer improvement funds?
Yes.
So it's like 22 years?
No, it would be, like MISA is like 12 years. It's because to Jeff's point before, there's a bunch of tranches. So 5 years is really not 5 years, because you've got 5, then another tranche that's a year or two later.
I understand
So
that.
It's not a clean 100% is spent and bonded at the same time.
No, I understand that, and I think MISA, again, I didn't do probably the last year, but we're at like financing over 16 or 17 years, I don't want to exaggerate here, but in that range. My question is, when we do 20-year bonding, are we doing the 20-year bonding after doing 2-year bands?
Yes.
We always do 2-year bands, whether it was for Witherall or for,
There was one exception a number of years ago. We moved the project renew up 1 year to try to capture interest rates that they thought were going to go up. That was
But-
the only exception.
but we still use the same kind of
Yes.
template,
Yes.
2-year bands, 20-year bonds.
Yes.
Thank you.
The next tier of interest expense that you have on here is changed one assumption, and that is that we would go back and ask for new RTM authorization to do 20-year financing on 50% of the fiscal, I guess it's fiscal 17 and 18 projects, the projects that have not yet been bonded, but we appropriated in prior years. And the key number from the chart you see here on this fourth tier, so our interest expense would go up to $80 million for that 15-year. Principal repayment would go down to $367, so that the total debt service over that time is $447. On the bottom half of this page, I did the net present value of the cash flows at 4 different interest rates. You're supposed to discount it at your cost of capital, so you can pick which rate you want to look at. But basically, it shows you that the debt service under any of this scenario, clearly the town is paying less. We're not paying the total cost of the project. But this is your common sense that if you do it over 20 years, you're going to have less principal repayments, less cash outflows. When you look at the, now the
Can I
big.
just stop on that one, too?
Sure.
So, can we get an estimate on our, we'll call it 7-year scenario and whatever, a couple of the scenarios to understand what our cost of debt is just in that. So because the cost of capital would normally be your debt and your equity, and in this case, for the town, it's only debt.
Right.
So it would be closer to our debt cost. So I'd just like to understand,
So
I mean, to working with your model.
Right.
But I'd like to understand if we move this.
So we
and
bracketed,
did
what these numbers reflect, we bracketed the 5-year and the 4-year and the 20-year. So the 5-year debt and the assumption, and that's always in our capital model, is 2.5% for 5-year.
Is 2.5?
Yep, and the 20-year is at 4.0. Pete's estimate was it's 150 basis points over the shorter
Okay.
duration. Our bands are coming in at less, so it's kind of not including the band interest rate in that cost of capital. But so it gives you that range, whatever you want to pick in that range.
And Pete was the source of the 150 basis point differential?
Yes.
Okay, thank you.
So just to turn to the longer sheets there, just so you can see what it does to our debt policy limits if we change, because we know that total debt's going to increase over the 20 years. We're not retiring it as quickly. And you can see, using the same tax levy that's in the budget model, we still stay underneath the total debt as a percent of grand less cap that we approved in December. We're below the 0.55, and we're also within all the other measures. The real benefit to going to 20-year, and the concern that people have, is what do you do with the either extra capacity you have to add debt or the ability to reduce your tax levy and to reduce the pressure on the mill rate. And so there is one more model we ran which holds the tax levy flat at the 50 million we have this year. So you can see I believe we stay within the debt limits, or we're really close on most all the measures. If we adopt the 20-year, we could hold our tax levy where it is today and still be able to do this Board of Ed capital plan within these measures, and the projects are expected. So that's the benefit, and I understand that's the fear that people have of changing to a 20-year model. Would it put us into a spending frenzy, which I don't think is what anybody's intent is. It's to relieve some of the pressure we have on taxation and to spread and to align ourselves with what the common practice is in all other communities and most municipal finance, which is to align the life of the debt over the life of the asset.
But I must say, we've been very special, and the question is, do we really want to align? And, I think we're admired by everyone because we don't have this debt, and we haven't made future generations pay, and exactly the fact that we're not paying for past generations. They took care of their obligations, and not quite as well, but pretty much we're taking care of our obligations. So it's really a whole different philosophy. But I do think that looking at these things is very constructive. And, quite frankly, I'd almost like to look at the same thing as a baby step with the, I'm not going to speak for my colleagues, but the sewer maintenance fund, where we're on the, at least, take some steps here where we're only on the pay-as-you-go system, not modified pay-as-you-go. So, again, that requires charter changes and so forth, but the burden in that fund is probably more severe than it is here. And, we're all in the sewer fund because it's based on value, and because we have many more institutional users. Those of us in residential are picking up more and more of that burden. And so I am very interested in seeing how we all can work together to, at minimum, move off of pay-as-you-go to modified pay-as-you-go, which is what we're using in the town.
I wish you didn't do all this work because I had all this done. So just looking at the perspective of We know interest rates are different on different term borrowings. We know we would have to have all these separates, but I just want to make this pretty clear. Going back to some of the calculations we had from actual bond quotes from the different times that I've requested from the controllers, I just want to be clear. You want to, because every time you, on our current rates, every time you borrow $8 million, the way we do it versus a 20-year note, you're picking up about $1.2 million in extra debt. So as I see this right now, and I appreciate the hybrid model, but I see this as, with the amount of borrowings we're doing projected, and you can't speak for that as much as I can. So you want to pick up an extra $12 million of debt on the books a year, so that's $120 million of extra debt to the town over the next decade, and that to me sounds like 3 major school renovations being paid to interest rather than being paid to how we do it now. That's a pretty big bite to the analogy of spending your kid's inheritance comes to mind on this. So obviously, as I've always said, I think I don't think the need has been demonstrated where we put ourselves in any burden for retiring debt. It allows us to throttle, like when the economic meltdown hit in 8, hit again in a little bit in 13 or 14, whatever year that was, that it dipped a little bit. It gives us a lot more control to throttle. So obviously, at this point in time, I don't see a need to switch our financing model. It would also change your outstanding debt in all the charts that we have and that we've been talking about, because your outstanding debt goes up with the longer commitment, which you haven't taken into consideration.
But it's on this chart.
Yeah, but
so
I'm
you see
talking
it.
about,
And it doesn't exceed the levels that we've been seeing.
no, my point is total outstanding debt. So if you were to convert over right now in the coming year, a year from now, you would have made the commitment for that financing with those payback schedules, principal and interest. So your total outstanding debt on the books would bubble. It would go up because you have a higher amount of interest you're paying. Obviously, it's pretty simple. The longer you have the money, the more you got to pay.
Right.
So.
The total debt outstanding is higher with a 20-year financing.
Absolutely. Right.
But it's not of levels, using these assumptions, it's not of levels that are total debt numbers that we haven't seen as a town.
Well, I would say that
Are you capitalizing interest? Is that how you get your number so high?
Absolutely, total payment on the project. If we do an $8 million project right now, at the current rates, our payback is about, I'm just going to use round numbers, $750,000 in interest, depending on there's some other fees in there on the initial 2 tranches. If we borrow $8 million today, under the current interest rates, and I think they're up 1/4 point, so I may be off a little bit on both, because of the difference rate, we pay about $10 million, almost $10 million one payback.
Okay, but you keep you're doing a present value, not even a present value of the interest, you're just accumulating future interest costs. You're not accounting for the time value of money in that number. So over 20 years, that makes a big difference. $1 in 20 years from now is very different than $1 5 years from now.
I'd like to go back 20 years from right now and tell me what the dollar was worth. Certainly, if we go back at least 12, the dollar's worth a lot less right now than it was 12 years ago before the meltdown. So I don't do present value. I do total payback, what the obligation, when we authorize the borrowing, what did we just commit the citizens of the town for a payback number?
Yeah. And
We're just discussing the time. You're doing the time, but I'm talking about total expense on the project.
Right, and I'm saying that that's probably not an appropriate way to look at it because of the length of time.
Wow, you better tell that to all the BET members going back to the 20s.
That's not who we want to consult.
Well, I don't want to be other communities either. I could pick a lot of communities in Connecticut. Matter of fact, I can't pick any community in Connecticut I want to be like.
Right. Well, and look, I'm putting these charts are there for discussion purposes. I think they show, I don't think you're hearing that there is a need to go to this model so that we can increase our debt, our ability to do projects. We're not getting that request from our departments. We're not looking to create additional debt capacity so that we can do more throughput, which would then concern you, I think, is as you look at how we limit and control our spending. But it gives us flexibility if there's an emergency that comes up. It also is, from a financing policy perspective, in line with what accepted municipal financing practices are. So that, that's the purpose of the discussion. I think that we can look at the numbers a little bit in a different way, but I appreciate hearing how you're interpreting the numbers. Any further discussion on? Nope.
No, it was good. Thank you for
Okay.
doing all the work. Roland, Pete, whoever.
So moving on, the next item on our agenda, we're just approving minutes. I do have to say the Budget Committee is behind in getting our minutes done for all the meetings that we had in February. If I can have a motion for our minutes from January 29th, the budget presentation and public hearing.
So moved.
I would second Leslie's motion.
Okay, so moved by Leslie, seconded by Jeff. Any changes to the copy that's attached to our agenda? Hearing none, can we vote on approving the minutes? All those in favor?
Aye.
Aye. Then our February 1st, departmental reviews. We skipped over the Board of Ed minutes. Those are not yet complete. So the February 1st meeting, can I have a motion to
So
approve
moved.
those? Move it.
Seconded.
So a motion by Leslie, seconded by Jeff. Any amendments to the minutes? No. So can I have a vote to approve the minutes?
Aye.
Aye, 4-0. February 5th, I don't think everybody's completed their review of February 5th, so we're not going to approve.
I make a motion to postpone those minutes to our next meeting.
Okay, so
Seconded.
we'll post, all those in favor of postponing?
Oh, yeah, I'm in favor.
This is what we're circulating, but hasn't yet been commented.
There is
Um,
no way with
so-
all the meetings we've had that you can keep up with doing all that.
February 13th was our monthly Budget Committee meeting. We had those minutes attached to here.
So moved.
Move second. All those in favor? Aye. Okay. And so our next meeting is April 7th, 2018, at 5 o'clock. And if I can have a motion to adjourn.
I would so move.
All right, thank you.
Second.
That's our normal date, right?
Yes, yeah,
But
okay.
what about
What did I forget?
No. What did we?
We haven't yet.
the salary increases in the budget?
Oh.
Oh, yeah, we did skip over that. So let's just go back before, so pretend we didn't adjourn.
I withdraw my motion to adjourn.
So the issue came up during our Budget Committee meetings, and we added it as a special agenda, as a additional agenda item, Roland. Thank you for reminding us. The issue came up during our Budget Committee meetings that the way that the departments have handled the salary increases for all employees is to use an average 2.5 for those contracts that have not yet settled. For the other employees, we use the actual GWI included in their contracts. There was some discussion on whether we should be budgeting at 2.5% or should we be budgeting at a lower number, either 1.5% or 0, because we don't know how those contracts will settle, and we don't want to make an assumption in here that can be used during the labor negotiations. And I know that we're not going to act on this today with a recommendation from the Budget Committee, but let's use this as a vehicle for discussion.
So,
Mr. Mason.
so I was actually the one during the budget meeting saying, oh, no, that's going to be a pain in the neck, or it's going to cause an issue, we're going to get a one-time savings, but then we're going forward. But then when we spoke to Alcava, and he said this could be something beneficial in labor negotiations because the current number being used by the people negotiating labor contracts is 1.5%. So I said, well, okay, but I think labor negotiations are far more than that. They'll talk to us on our ability to pay, they'll talk to us on our fund balance, they'll talk to us on our grant list. Having sat through some of those, it's common to hear that. What I would say is that I did check in with Roland on this, and obviously on a town department-wide, we could probably, as a BET, make this one motion, the following departments, all 100 MOCs. But when it came to the Board of Ed, it would be a challenge for them to do it because they don't do,
But I think they can do it. We can't.
right, no, I get it. But they don't do it by position control, right? They don't have it that way. You were explaining to me, and if it's that much work,
we can pull it out of the payroll system, because that's how we populate the budget.
Gotcha.
It's in their budget somewhere. So I spoke to Lori.
Okay,
Also, it's a limited number of unions that still don't have contracts. I
It's
mean,
only
we're only
four.
talking about,
Four
no,
for
it's
next
even fewer than that, right? Haven't the nurses look like?
It was
that-
approved last night.
Was approved last night, so it's, I think we're down to 3.
What we have
Or-
open is LiUNA, paraprofessionals, and the police contract is up. So it's those 3.
so,
And
But
fire.
what we can
wait a
do,
minute, there's got to be one more. LiUNA,
Is fire?
that's the fires are
Fire's
in
good.
arbitration. LiUNA, the paraprofessionals,
LiUNA nurses, or.
and then the
The
nurses
No,
are
nurses
done,
have been done.
Board of Ed.
and the police.
okay. So,
GME has a contract.
yep, they're done. Administrators are done.
We can assume everybody has 1.5% increase,
I think that that's a good amount.
and we can give you that information.
I think that that would be a good amount, since that's where we've settled the other 2 contracts. And you know, I would like to see this at least try a 1-year experiment. I mean, you know, not to say we're going to do this, but let's just see what happens if we do this for 1 year.
I, for one, am disinclined. For one thing, I don't like to play with assumptions in the budgeting. I like it when the assumptions have a consistency from year to year, because it's a little easier for us to see what's happening, easier for the taxpayers to see what's happening too. Number 2, you all may have had conversations with Al Cava that I wasn't party to.
No, we
but-
were all in the
Excuse
same
me,
room.
Just
We're
let
at
me,
the-
please let me speak. But if we're hearkening to the conversation that we had at the Budget Committee with Al Cava, he was quite clear with us.
We have to be careful about what we talk to.
Yeah, that was an executive session.
He was quite clear with us that, that we do not achieve anything by making the change that you're discussing, that nobody out there thinks that the town of Greenwich is unable to afford the salaries of its employees. And what the arbitrators are deciding are fair, appropriate salaries for the job being performed, not based upon what budgeting the town did. And so he expressed an indifference to this particular item, and I don't view that indifference as being motivating for me to make the change. On the contrary, in our budgeting process, we usually try and reach for conservatism, and that is to budget for at least enough, probably a bit more than what's actually needed, so we avoid the problem of finding ourselves short on an occasion when we've had a nasty surprise based upon an arbitration outcome or something with the union. So for myself, I would continue to do exactly what we've done before at exactly the same figures. I think it has served us well. I wouldn't want to make the change, at least not this year.
And I just had this thought, when I think of the RTM actions on budgets, sometimes on contract, or on contracts more than budgets, on contracts, we would then need to go to the RTM for approval for the contract and an approval to appropriate the money to fund the contract if somehow the award were higher than what we budgeted. They, in some cases now, have been postponing indefinitely contracts not to go on the record of approving a contract. So we would have to go in with 2 separate motions, one on the contract, which maybe they postpone indefinitely, but a second resolution where they appropriate the salary dollars, because we're moving it then from fund balance into an account that's not already been budgeted.
The RTM actually does not approve contracts. Contracts are signed between, on the town side, between the First Selectman's office and the union. What the RTM approves is the cost of the contract. And in some cases where we actually budgeted, say, a 2.5% increase without a contract, if the contract came in at 2.25%, technically, they would not have to approve that contract because the funding was
The
in place.
money's there.
Which is why we put a resolution in the budget to say, even if the money has been appropriated and approved by the RTM, we can't spend it.
So now go to the reverse. The reverse is we haven't appropriated the money. We only put 1% and 0% into
What-
each of these
what-
salary
what
lines.
What happens, Al Cava goes to the RTM and says, here's the contract, I need an allotment. We settled LiUNA, I need an allotment of $400,000.
Right. And the RTM doesn't want to approve that cost of contract like they've done before. They want to postpone it indefinitely. They will have to vote affirmatively, though, on approving the money. So, you know, we've added a hurdle here that we'd have to explain, and if they don't approve the money, then we haven't funded this contract.
There's a latent other piece to it, too, and that is that in that hypothetical, when you budgeted 0% or 1% or 1.5%, and in the end, the settlement or the arbitration came in higher, then you whimsically said you're going to pay it out of fund balance. The fact of the matter is, you're paying dollars that we haven't taxed for. And as a matter of fact, you've kind of misrepresented yourself to your taxpayers as having an apparent budget at a lower level, when you get done with the interim appropriations necessary to cover these nasty surprises, you're actually running a town at higher expense than you represented to your taxpayers with the mill rate that you presented to them at the time that you sent the bills.
And one of the things that was done in the past was on the mill rate calculation sheet, there would be zero increase in the departments because there was no contract, but there would be a number on that mill rate sheet that said contingency, and it would, you would tax for the contingency.
That's how we used to do it.
I like it better to have the nice steady arrangement at the 2.5% rate, and there's a consistency. You can look at your budgets year to year, and they're all based upon the same assumptions, not funny money.
No,
Those are some terms that could use a point of order.
All right. So we
With
want to
that
get
said-
the
with
issues
that
on the
said-
table.
A little like presenting who's running for what office, is that it?
Okay.
That's
All right,
strike two.
let's
Okay,
attend to the
To me,
issue.
though, what do you think this number is across all these bargaining units?
We just ran the town side. We've got to look at it again tomorrow. Probably in the neighborhood of plus or minus $600,000. Probably another 150 to 200 on the Board of Ed side.
I'm sorry, I must have missed the point. The 600 and the 150, what are you speaking of?
Both sides, Board of Ed and.
How much the change from 1.5 to 2?
The difference.
What would be the difference if we made assumptions at 1.5 instead of 2.5?
That's what I'm saying.
That's
Thank you.
That's
the
what it
total
is.
number. So,
Thank you.
So,
So it's somewhere between 7 and 8 in total, somewhere in that range.
okay, so the question is, are we raising tax levy? Because that's typically not being spent, because we're seeing that. So are we raising tax levy unnecessarily to cover this conservative approach to what the bargaining
All
units?
combined, it's about 1/4 point.
Well, I don't know if it's fair to say we don't ever spend it. I think it's just,
We haven't had a department not have enough funds in their original budget, other than the year that the RTM cut. Remember, they cut in the fire department administration. We had the water contract. We had to do that transfer.
We had the tax collector last year.
But we didn't have any department that needed to come back for more operational funds.
You had departments that you had to tell them to cut staff because they weren't within their budget.
all right,
Tax
let's, that's one particular instance. So, all right, I think we laid the issues out on the table. I'm not sure I know how I come out on this yet, but if there are no further questions, then Leslie, would you like to make your motion again?
I will.
I would second it again.
Motion to adjourn. Thank you.